Hey guys. Hi. Shh, we're not supposed to talk right now. I thought we were here to learn about making money. We are, and to be more specific, we're going to talk about index funds. Then why can't I talk? You can. I'm just trying to do an introduction right now. To whom? I'm pretty sure we all know why we're here. To the viewers. Like me. Let's just get to it. He's supposed to say that. Say what? Let's get started. So, I think it's really important that we go over index funds because it's a really good way to invest. And since this is an investing channel, might as well go over it. So, first, let's figure out what an index fund is. An index fund is a type of mutual fund or exchange trade fund with a portfolio constructed to match or track the components of financial market index, such as the S&P 500. An index mutual fund is said to provide broad market exposure, low operating expenses, and low profile turnover. These funds follow the benchmark index regardless of the state of the market. Index funds are generally considered ideal core portfolio holdings for retirement accounts, such as individual retirement accounts, IRAs, and 401ks. Legendary investor Warren Buffett has recommended index funds as a haven for saving money for later life. Rather than picking out individual stocks for investments, he has said it makes more sense for average investors to buy all the S&P companies at the low price an index fund can offer. But you also have to remember,
no one knows the best way to invest. So you have to take it into your own hands and do your research and figure out what you think is the best way for you to invest.
yeah, and also, I'm not an old geezer. Watch yourself. I'm no geezer. You don't need to be old to invest in index funds. How do you invest in index funds? Yeah, what he said. Indexing is a form of passive fund management. Instead of a fund profile manager actively stock picking and market timing, the fund manager builds a profile whose holdings mirror the securities of a particular index. The idea is that by mimicking the profile of the index, the stock market as a whole, or a big segment of it, the fund will match its performance as well. There is an index or an index fund for nearly every financial market in existence. In the US, the most popular index fund tracked is the S&P 500. But the S&P 500 isn't the only index in town. There are indexes or corresponding index funds composed of stocks or other assets that are chosen based on company size or capitalization. These are index funds that track small, medium, or large size companies. Geography. These funds focus on stocks that trade in foreign exchanges or a combination of international exchanges. Business sector industry. These will be funds that focus on consumer goods, technology, or health-related businesses. Asset type. These will be funds that track domestic and foreign bonds, commodities, and cash. Market opportunities. These will be funds that focus on emerging markets or other growing sectors for investment. Portfolio of index funds substantially only change when their benchmark indexes change. If the fund is following a weighted index, its managers may periodically rebalance the percentage of different securities to reflect the weight of their presence in the benchmark. Weighting is a method used to balance out the influence of a single holding in any index or a portfolio. Okay, I think I get it. Yeah, but I can just pick stocks out on my own. Yeah, but why do it on your own when knowledgeable index managers will do it safely for you? Can we do both? Yes, guys, we can do both. I'll explain why one will use an index. Investing in an index fund is a form of passive investing. The opposite strategy is active investing. One primary advantage that index funds have over their actively managed counterparts is the lower management expense ratio. A fund's expense ratio, also known as the management expense ratio, includes all of the operating expenses such as payment to advisors and managers, transaction fees, taxes, and account fees. Since index fund managers are simply replicating the performance of a benchmark index, they do not need the services of research analysts and others that assist in the stock selection process. Managers of index funds trade holdings less often. This incurs fewer transaction fees and commissions. In contrast, actively managed funds have larger staffs and conduct more transactions, driving up the cost of doing business. The extra cost of fund management are reflected in the fund's expenses ratio and gets passed on to investors. As a result, cheaper index funds often cost less than a percent compared to the much higher fees actively managed funds command. Expense ratios directly impact the overall performance of a fund. Actively managed funds with their often higher expense ratios are automatically at a disadvantage to index funds and struggle to keep up with the benchmark in terms of overall return. Hey, wake up. Is he dead? Oh, hold up. I'm up. What's up? You fell asleep. You almost bored him to death. Don't worry about me. I'm not dead yet. Okay then, I'll simplify it into pros and cons. Pros: ultimate diversification, low expense ratios, strong long-term returns, ideal for passive buy and hold investors. Cons: vulnerable to market swings and crashes, lack of flexibility, no human element, limited gains. So do index funds give you better returns? Well, I'm definitely not talking to you. Lowered expenses lead to better performance. Advocates agree that passive funds have been successful in outperforming most actively managed mutual funds. It is true that the majority of mutual funds fail to beat broad indexes. On the other hand, passively managed funds do not attempt to beat the market. Their strategy instead seeks to match the overall risk and return of the market, on the theory that the market always wins. Passive management leading to positive performance tends to be true over the long term. With short-term time spans, active mutual funds do better. Even over the long term, an actively managed fund is good. Very
Good.
How exactly do I pick an index fund? Flip a coin. No, not that way. Not that way. You're not technically an advisor though, right? So you can't really tell us exactly what to do. Correct, but I can give you some ideas on stuff that you can look into doing. Watch, he's gonna say something like buy and hold. He always says that. Exactly, but I recommend some indexes that you can look into. Okay, let's get to it. So, when investing with the index fund, you should look into investing with Vanguard 500 Index Fund. As the industry's first index fund for individual investors, the 500 Index Fund is a low-cost way to gain diversified exposure to the U.S. equity market. The fund offers exposure to 500 of the largest U.S. companies, which span many different industries and accounts for about 3/4 of the U.S. stock market's value. The key risk for the fund is the volatility that comes with its full exposure to the stock market. Because the 500 Index Fund is broadly diversified within the largest capitalized market, it may be considered a core equity holding in a portfolio. This is probably so expensive. It has to be like $1,000 or something. Actually, it's only like $324 right now. The S&P 500. The central advantage of using the S&P 500 as a benchmark is the wide mark of the large cap companies included in the index. The index can provide broad view of the economic health of the United States. Okay, well this has to be like $1,000. I heard they're about to add Tesla into this. So Tesla's about $2,000, and so this must be a whole lot. Where did you hear this? How did you know that? Well, I might have watched 1 or 2 of his videos before. Well, thanks for watching. I'm guessing you watched the Tesla joins the S&P 500 video? Yep, I watched it. That's the one. Yeah, well, the S&P 500 is around $3,000 right now, which is very expensive, but it's well worth it. Where can I invest? Indexes are sold with a lot of brokerages. I suggest researching to find the best one for you. But my favorite brokerage is Robinhood. You should definitely look into it. Also, in my description section below, I have a link where you can go to Robinhood, sign up for it, and get 1 free stock just for signing up with the link. I also have another link to Webull, which is another brokerage, where you can just go ahead, click on the link, sign up, and get 1 more free stock with that Webull account. And when you deposit $100 into that Webull account, you can get 1 more free stock. So pretty much that's a wrap for this video. Did he say video? Yeah, he's been recording this for his YouTube channel. Where? First of all, we gotta stop talking. He's trying to wrap up the video right now. But the camera's right there in between us. You don't see it? Thanks for watching. Hope this video helped. Remember, smash the like button. You know, the YouTube algorithm really loves when you do that. How do I like? Just turn the thumbs up button blue. I gotta take my glasses off because I just can't see. What do you mean? Just press that button right there. Press that thumbs up button. It'll turn blue, and we'll be all good. Oh my, you kids with these gadgets, like you don't understand what it was like back in my day. Also, remember to subscribe. I love when you guys subscribe. It makes me so happy. And it helps me help you keep up to date on investing. How do I do that? Just click the subscribe button. I am, but it's just turning red. Don't worry then. If it's red, you're subscribed. You're good. You're good. Thanks again for watching. See you next time. He's so nice. Why can't you be more like him? What do you mean? You always yelling or got some attitude. Just turn off the camera. It's fine. Just turn off the camera. How am I supposed to turn this off? How? Never mind. I get it. It's fine. It's fine.